Let's talk about second round effects. I mean, you mentioned there, Bert, this isn't 2022. This is very different for a whole host of reasons. I think most people agree that getting back to that sort of 2022 inflation wave is unlikely. But nevertheless, the ECB does worry about higher energy prices spilling into the rest of the inflation basket, and I suppose those concerns will be heightened if we do go much higher on energy prices. I mean, is there much sign of that so far?
So I think so far it's been relatively benign. So of course we've seen the big surge over the spring, and there we saw that businesses were immediately much more keen to price through higher costs to their customers. So we see in surveys from the European Commission, for example, that a large amount of goods producers were planning on increasing their prices in the months ahead. That usually correlates quite well with goods inflation in the consumer basket as well. So that's definitely something that we will see. But we already did see as well that surveys in June and May were already showing fewer companies that were willing to increase prices. So there's been a small tick down. Not that that means that we're not going to see a further increase in core inflation, but it does mean that sort of the sharp edges are starting to come off, or were starting to come off a little bit. Of course, when oil was back at 71 or $70 per barrel, at that point it becomes a lot more difficult for corporates as well to start to price through higher costs to their customers, because if they point to higher commodity prices and everyone can see that oil is back at where it was before, then that does make it harder to price through those few months of extra cost to their customers. But now that we're back up close to $100 per barrel again, that burning platform becomes larger. And of course, it means that the chances of businesses trying to pass through those higher costs to their customers increases as well again. So if we look at those direct second round effects of what's happening here, the risks around those are starting to increase again with current prices, even though signs were very encouraging in the months before. But maybe we can take that even broader, James, and also look at the labor market, which is a much slower second round effect that you usually see happen in 22, when we had inflation past 10% in the eurozone. We did of course see that that resulted in a slow but sure increase in wages that came on the back of that. And the ECB invested a lot in trying to make sure that they understand that labor market well and understand those wage moves quite well as well. So they've introduced a new wage tracker that they didn't have before the previous energy shock. And if we look at what that wage tracker is currently showing us, then we are seeing that it's showing very little effect so far. The ECB tracks big negotiated wage agreements across the eurozone with that, and it's not showing much effect yet. Even though we are starting to hear that unions are immediately trying to recoup purchasing power from the increased inflation that we see so far. But let's be honest. I mean, with inflation around 3%, that's not really something that's going to bring about a big wage wave on the back of it.